Okay, so this week is a little bit different. First of all, we can talk about the paper now. And then the second way that it's different is we can, instead of covering, like in week 1 and 2, you learn the entire accounting cycle, right? And this week and next week, what we're doing instead is like 4 separate, clearly distinct topics. You know, like we'll look at inventory. Actually, there's 2 chapters on inventory. So we'll look at inventory, how to record it, how to apply the cost for it. We'll look at, like we might look at cash and we'll do bank reconciliations and control procedures. We'll look at accounts receivable and how do you account for uncollectible accounts. So there's many topics, small topics, but several. So that's how this week differs. So with the paper, what I'm looking for is for you to do a couple of things. I'm looking for you to do research in the library, because if you don't know how to use the library, I'll go over it with you. Because I want you to come out of this class knowing how to use the library, because a lot of people that don't know how to use the library feel like it's easier to Google it. But if you know how to use the library, it's not. The library is a lot faster. Plus you get higher quality information. So I'm looking for you to know how to use the library. And I'm looking for you to write a short paper about any topic having to do with accounting, preferably that interests you. Now, that doesn't mean that every single one of you will find something in accounting that interests you. I understand that not everybody feels about accounting the way I do. But so in the announcements, you'll see a post with some ideas. That's all it is potential ideas. You're not confined to them. You are welcome to think outside of the box. You're welcome to, give some thought to, what like offshoots or ancillary things that might be interesting to you. I don't think I've ever said no to a topic. If you want to run it by me, sometimes I say, well, let's limit it, or let's, make sure you include this. But really, it's something that I would like you to be as interested in and as engaged in as possible. All right, does that make sense for kind of like just looking at what you want to write? Okay. All right, now, you have learned a ton so far. We should celebrate that. You have learned account names, you've learned the accounting equation, you've learned all the financial statements, you've learned debits and credits and journal entries, you've learned adjusting entries, the trial balance, closing entries. You have literally gone all the way through the accounting cycle, a whole month worth of an accounting cycle. So that's something that you should be proud of. Now I'm going to share what we're going to talk about today. So today we're going to start with inventory, and then we're going to look at accounts receivable. Where'd it go? Oh, there it is. And there are videos that are posted. There's videos that are posted that talk about inventory costing, especially FIFO, LIFO, which we're going to get into tonight, weighted average. I would not expect you to feel secure after we talk about it tonight. I would expect tonight to really help you start to understand it and to help you see how the lab works as far as the assignments go. But I have several resources there, including a spreadsheet that I put together that you could also use for like the quiz when you're doing problems. The quiz is the problems on the quiz are easier than the problems in the lab. But we'll do those on Thursday. Okay. All right, so what we're doing here is we're going to purchase inventory. There's two methods for recording inventory. There's the perpetual, let's write this down. There's the perpetual method and there's the periodic method. We're going to be doing the perpetual method. We'll look a little bit at the periodic method. The periodic method is in the appendix of the chapter. So the perpetual method, you have to have barcodes. And with the perpetual method, the accounts that we use to record inventory are much more intuitive than they are with the periodic method. In addition, with the perpetual method, you're always going to understand what your cost of goods sold is. So when we do the sales transaction, we're going to record both the sales transaction the way we've always recorded it, and we're also going to reduce inventory and record costs of goods sold. The most confusing thing about this chapter is that you wear two hats. You are both the buyer of inventory, and then we're going to look at what happens when you're the seller. And so that's one of the most confusing things. You always have to really be clear when you're doing this chapter on, what am I buying the inventory to resell it, or have I sold the inventory to somebody else? Okay, so we're just going to dive in and do the journal entries because it's the easiest way to explain it to you. All right, so if we purchased $6,800 of merchandise inventory from Lion Company with credit terms 215 net 60, let me explain that. So for credit terms, what we're talking about, just figured out how to change the color. Oh, there it is. Okay, for credit terms, what this means is 2% discount if paid within 15 days. And then everything's due in 60 days. There are all kinds of ways to write that. I mean, it could be 110 net 30. You get a 1% discount if you pay within 10 days, everything's due within 30 days. It could be 315. This is a new one for you, EOM. This is really hard to record in accounting. So 3% discount if paid within 15 days, everything's due by the end of the month. So that's a discount, and it's offered to encourage the purchaser to pay more quickly to accelerate the cash flow. Make sense? Okay. So I'm going to clear, move you down here back again. I'm going to clear this and we're going to talk. All right. So we purchased $6,800 worth of merchandise from Lion Company with credit terms 215 net 60, which don't matter when we purchase them. But one of the things about this, because we're dealing with discounts, is we want to, sorry, lost my pen. We want to record, we want to write down on a sheet of paper to keep track of where our, to keep track of how we are recording, like what goes to Lion and what goes to somebody else. So like I'm sitting here with a piece of paper and I'm going to write just to keep track. We're buying from Lion, so we're going to pay them. So we have accounts payable to Lion, and it starts out at $6,800. So accounts payable is a liability. So we're starting out with this. Okay, now I'm going to record when I purchase the inventory, and I'm going to set you off right. So the nice thing about the perpetual method of inventory is that it's intuitive. We're going to increase the account that you would think we would increase. We're buying inventory, we're going to increase inventory. So we're actually going to record merchandise inventory for $6,800 and accounts payable, because we're going to pay them later, $6,800. That's simple, right? I mean, it's kind of new, but it's what you would think if we bought inventory. Good here? All right, so the next one is kind of interesting. We're paying $300 cash for shipping charges. Okay, the way inventory works is we're going to hold under inventory as an asset on our balance sheet any inventory that we purchase and any costs associated with getting the inventory to us and ready to sell to our customers. So that means this $300 that we just paid for shipping gets included in the cost of the inventory, because it's going to sit on the balance sheet until we move it to cost of goods sold. So the interesting thing about this is we can obviously see we're paying cash, but we're actually going to increase inventory for this. And we'll pay the cash. So now if we looked at our inventory account, it would have the $6,800 from Lion plus the $300. So it would be $7,100 in inventory. All right, are we good with the, and this is only for shipping charges to bring the inventory to us. When we pay shipping to send what we sell out to our customer, that's a shipping cost. Does that make sense? Are we good? Are you guys sleepy?
No, good.
Okay. Good. All right, so we'll record that entry. All right, so now we're gonna, we've opened the merchandise inventory. The box came in, we opened it up, but we found that some of the merchandise was not okay, wrong order, whatever. So we're gonna return it. So we're gonna return $800 worth of the merchandise back to Lion. So it's exactly what you would think. We're going to decrease our account payable for $800, because if we're returning it, we're not going to pay them, right? So we're going to decrease our account payable, and we're going to decrease our inventory. So we're just going to take out of accounts payable what we put in, and we're going to decrease our inventory for $800 because we returned it. Good here? Kind of intuitive. Are we good here? Okay.
Yes.
All right, now we're going to get to paying them. So now we're going to send them a check. So what I'm going to look at here is I'm going to say, okay, let me figure out what I owe them. So I owe them $6,000. But the credit terms are $215 net 60. So that means I get a 2% discount if I'm taking the discount. So I'm going to say, all right. So I'm going to look at two things. So if I owe $6,000 and I get a 2% discount, I'm going to write my check for 98% of $6,000.
5880.
Thank you. And my discount is going to be 6,000 times 0.02. Are you that fast too?
120.
Okay. So when I do my journal entry, I'm going to decrease my inventory, the $120. So let's piece this together. So the first thing I know is that I'm sending them a check. So I'm going to pay cash, right? So I know I have to credit cash. So I'm going to reduce cash. We know I'm going to write them a check for $58.80. All right, now.
Excuse me, Professor, question.
Mm-hmm.
Where did you get that 98 and the 0.02?
Because they get a 2% discount if paid within 60 days.
Okay.
Okay.
And within 15 days, right?
15 days. Yeah. Sorry. Everything's doing
net 60.
Yeah. So they get a 2% discount. We get to take a 2% discount because we're paying quickly.
And we're paying on the 4th and we purchased on the 2nd, right?
We're paying on the 17th and we purchased on the 2nd.
17th. Okay.
Good.
Was the N is net, right?
Yeah. So net of the discount. Oh, the N is everything else. Yeah. Net, everything else, basically.
Okay.
I mean, the way I translate it is you get a 2% discount if you pay within 15 days. Everything is due within 60.
Okay.
Or what it really means is the net balance is due within 60.
Okay. Thank you.
You are very welcome. All right, so I know. What happened there? So I know that I'm going to decrease cash 58.80. I know that. That's what I'm going to mail my check for.
Mm-hmm.
Now, when we're done, right now I owe Lion $6,000. When we send them this $5,880 check and they receive it, are we going to owe Lion anything more?
No.
No, we're not. We're paying them $58.80 in satisfaction of the $6,000 that we owe them, correct?
Mm-hmm.
So what I'm going to do there is I'm going to say, okay, I need this to be 0. So if I need that to be 0, I need to debit the account payable. So I'm going to debit the account payable to take it off my books for $6,000. The difference is the $120.
Yep.
In Perpetual Method, we reduce the inventory account because I actually didn't pay that $120 for inventory. Besides, whenever you're in doubt and you're doing perpetual, when you're in doubt, just think it probably goes to inventory. All right, are we good here?
I have one question.
Mhm.
The shipping cost to return the $800 of damaged merchandise, who pays that shipping charge?
You know what? That would depend. If we pay it, we need to record an entry for that.
Okay.
Yeah, we paid shipping charges and cash, right?
Yeah, so unless they sent us a label, we'd be paying
right.
it out of pocket.
That would
and
be
we'd
another
record that as an
transaction.
expense. Would we record that as a shipping expense typically? Because it's just the cost of doing business, or will we record that to merchandise inventory again? Because it's not really adding to our inventory because we're returning the item.
We're taking away from our inventory. You know, I don't think either would be wrong,
Okay.
but
As
it
long
might,
as you continue to do it the same way.
yeah, as long as you do it the same way. But it's almost like we should record it as a reduction in inventory because we recorded the shipping, the freight to bring it into us as inventory. So it
But that's
almost
going
seems
to
like,
a cost of expense.
well, but it still has to do with securing the inventory,
Okay.
but I don't think it's going to be material.
Okay.
Those are good
Thank you.
questions. You guys are thinking. What's up with that? Okay, number 6, same thing. Now we've purchased $12,900 worth of inventory from Frist Corporation. So I'm going to do my T account here because I know I'm going to need it for payment. So we're still purchasing, it's still accounts payable, and this is $12,900. But this time, my terms are 1% discount if paid within 10 days. So I'm going to do exactly what we did before. I'm going to increase inventory. And I'm going to record my account payable to Frist for $12,900. Look good? Sound familiar?
Mm-hmm.
Okay. Next one is, okay, so in this case, we opened the container and there's some merchandise there that we're like, you know, it's okay. We don't want to return it. We can sell it, but it's damaged or whatever. So we're not going to be able to sell it for the full price. So we want you to give us a discount. And they said, okay, if you'll keep it and you can sell it, we'll give you a $500 discount. So when they give us that discount, we know, first of all, that we're going to reduce what we owe them because they gave us that discount. And then just like when I said, when in doubt, it's probably inventory, we're going to reduce our account payable by the $500. And we're going to reduce inventory because we didn't actually pay that $500. We paid less than that for our inventory. Good so far?
Mhm.
And then last but not least, we're going to make our payment. So first we're going to figure out what do we owe. And we owe $12,400. So we're going to say, okay, we owe $12,400. We get a 10% discount. So we're going to mail a check for 90%. Wait, we get a 1% discount. I knew there was something wrong with that. You get a 1% discount. So that's our discount. And this is what we're going to write our check for. So if we take 12400,
12,276.
thank you. What is it? 12.
12,276.
Do you do the discount?
No, I didn't.
Minus
Not yet.
2276. Wait, I got it. 124. Okay, so what do we know? We know that we're going to mail them a check for cash for how much?
12,276.
Yep. And we know that we're going to pay off the entire account payable. So the difference is our discount. And what is that going to come off of?
Inventory.
Merchandise.
Yep.
Inventory.
Yep. All right, you guys got this. This is good.
I don't think I really understand why we're crediting the merchandise inventory, because don't we still have that inventory? So why would we have to take the 124 away from it?
We have the inventory, but we didn't pay that $124 for it.
Oh, okay.
That's
right.
There's a lot of put on your thinking cap with this chapter.
Yeah, because I'm thinking we still have the value of the inventory,
Mhm.
but we didn't pay for it. Like actually, the numbers didn't. All right, gotcha.
The way I think of it is if I go to the store and I buy a shirt and it was normally $60, but I get it for $40, do I think of it as a $40 shirt or a $60 shirt?
Yeah, I still think of it as the.
Yeah, that's
Sure.
kind of the way I think about what do I think of the inventory then, right?
Yeah.
Okay. Okay. Now, the first entry here, Allied is purchasing the inventory to resell. And then the rest of the entries, like Allied is reselling that inventory. So we've got two different things happening here. When we are the person that's buying the inventory, we reduce inventory for returning items. We reduce inventory for damaged items where we get an allowance. When we are the buyer, that's not true. I mean, sorry, when we're the seller and we're selling it, we want to keep track of those things. So we're gonna look at that. So this one's confusing because we have to put our hats on. So our first hat is we're going to be the purchaser for this first one. So Allied made its first and only purchase of inventory for the period on May 3rd. We bought 2,000 units at a price of $9 cash per unit. You okay? Why don't you look okay?
If I stay up for half an hour, can I just do it?
Sure.
Then can you talk to me about the most sometimes?
Okay, so the first entry is exactly like what we've done. So we've got, and they paid cash. So we don't even have a payable. So all we're going to do here is we're going to go down and we're going to record that they, okay, writing that didn't work, did it? We're going to record that they purchased merchandise inventory and paid cash in the amount of $18,000. Now, it is important to realize that we paid $9. So I am going to write that up here, that the original cost, so the cost was $9, because we're going to sell it for more than that. So the second item, now we're going to be the seller, okay? So now we're Allied. Now we're Allied and we're going to sell 1,000 units in inventory for $13 per unit to Macy. So now we're the seller. So there's a couple of things that we have to pay attention to. So the first one is how much they're going to owe us. So this is going to be an account receivable because we're selling to them and they're going to pay us, right? So we're going to get an account receivable from Macy. So the account receivable is going to be for $13,000 because they tell us. But if we took 1,000 times $13 per unit, that's what we get. And these credit terms are a 2% discount, 210 net 60. I know I'm going to need that later. All right, so we sold 1,000 of the units. This entry is no different than what you're used to doing. You're going to record the account receivable, and you're going to record sales revenue for $13,000. This you have done before. All we're doing is recording the sales revenue. Okay, good there? Okay, now the next part is our second entry. Whenever you're using Perpetual, when you have a sale, you have two entries that you make. One of them is to record the sale. The other one is to reduce the inventory and record cost of goods sold. So we're going to record cost of sales and reduce inventory. But we have to do this at cost. So we sold 1,000 units. So what we're going to do here is we recorded the sale at the $13 per unit. But in this case, we sold 1,000 units. And we're going to take it off our books at $9 per unit because that was our cost. So cost of goods sold is going to be $9,000. And we'll reduce really, sorry. And we'll reduce merchandise inventory $9,000. So when we're done with these two, what we've recorded is we have on our books sales of 13,000 and cost of goods sold of 9,000. So here we've recorded our sales at $13,000. Those go on our income statement, right? And then our cost for those sales is 9,000. So we have the 13,000 sales revenue minus cost of sales are 9,000. So we have 4,000 left over. What does this 4,000 represent?
Our markup or profit.
Yep, that represents our profit. Perfect. Okay. That tells me you've got it so far. Okay. All right, so the next one. Macy returns 100 units because they did not fit the customer's needs. Okay, this is where things get different. Macy is sending back 100 units to us because they didn't fit their needs. So the first thing we have to do is we're going to reduce what they're going to pay us, because if they're sending back 100 units worth $1,300 on their end, they're not going to pay us that $1,300. So what we're going to do is we're going to reduce the account receivable. And now we have a new account. And the new account is, what was this, a return? Yeah. Sales returns and allowances. So we have two new accounts. One of them is sales returns and allowances. And the other one is sales discounts. So these are a special type of count. They're contra revenue. Because on our income statement, if you look at the top of an income statement, you'll either see net sales or you'll see sales less sales returns and allowances and sales discounts. So when we are doing perpetual inventory and we are the person that is buying the inventory, we are not going to use sales returns and allowances. We're going to adjust inventory. But when we are selling to somebody else and they return merchandise to us, we're going to put it in the sales returns and allowances. And the reason we're going to do that is because we want to know what our returns and allowances are coming up to. Does that make sense? Because then you have questions like, why do we have so many returns, or why, what's happening?
I have one question. When does that get recycled back into merchandise? Because it's not defective, it just didn't fit their need.
Yeah, we're about to do that.
Okay, all right.
It's a very good question, because you're right. It has to go back in, because all we've done now is credit them at retail. So the next thing that's going to happen is we do have to put it back into inventory. So we're going to put it back into inventory at our cost, obviously. So now we're going to put it back into inventory at the $9 per unit. And we're going to back it out of cost of goods sold because we didn't sell it, they returned it. Make sense?
Yeah, you do cost of goods sold when you do your sales revenue, right?
You do sales revenue and accounts receivable. And then the second entry is to record cost of goods sold and reduce inventory. So now,
Exactly.
yeah, so now
Okay.
we're just doing the opposite of that. We got it back in, so we're backing it out of inventory and cost of goods sold. We did the same thing with the previous entry. We backed it out of sales. We just did it using a contra account.
Yeah, so but you, just like when you do prepaid insurance to insurance expense, right? Or I'm sorry, accounts receivable to revenue, you do it once you sold the good. That's when you make the separate entry for cost of goods
Correct,
and reduce the inventory, right?
correct.
Okay,
Yep.
I just want to make sure my timing is right.
Yep, yep, yep. Yeah, when you sell it, you have 2 entries you have to make.
Got it. Okay. Thank you.
Very welcome. Okay, so we did that. Okay, now Macy discovers that 100 units are scuffed, but they still think they can sell them, but they want us to give them a credit. So we're like, okay, we'll give you a $500 credit. That's fine. So the first thing we're going to do is we're going to take that $500 off of what they're going to pay us, because they're not going to pay us the $500 if we give them a credit. And then to record it, we're going to reduce our account receivable, $500. And we're going to do sales returns and allowances for $500. So the first one was a return. This one is an allowance, and we're about to see sales discounts. So Perpetual, as the buyer of the inventory, we just adjust inventory. As the seller, we're going to use sales returns and allowances instead of inventory. And then now we're going to get a payment. So we know that we get a 2% discount. So the first thing we have to do is we have to see, well, how much do we owe them? Well, I got to get a,
11,200.
so we owe them 11,200. So we know we get a 2% discount, or they're going
You
to
mean
take
they-
a 2%
You
discount.
mean they owe us?
Right, they're going to take that 2% discount. So they owe us 11,200. They're only going to pay 98% of that.
10,977.
Thank you. You're fast. And so that's our check that we're going to receive. So our discount is 2%.
224.
What is it?
224.
224. That's our discount. Okay, so now we can go and do our entry. So the first thing we're thinking about with the entry is how much cash are we going to receive?
They're doing it by the 15th, right? So it should be, we should be receiving 10,976.
Okay, but when we're all done, are they going to owe us anything?
No, they shouldn't.
Not
No.
after that.
Right, so we have to reduce it the whole 11,200. And
That says-
so
That says accounts payable.
that would be wrong. That's why I said is you really got to keep your head straight. And so the difference here is going to be sales discounts
Okay.
for 224.
Sales discounts. What kind of account is that? Is that an expense or is that a? What does that fit into?
Sales
under-
discounts is a contra revenue account.
Contra revenue, okay. So
Contra-
just like the allowance and returns.
Right. It has the same, it can be confusing with an expense because it's still a debit,
Okay.
but it's a contra revenue account. So it really just has the opposite balance as a revenue account.
Got it.
Okay. All right. So that was a lot to work through.
Yeah.
I know, right? Okay, so this is just goods available for sale, cost of goods sold, and gross profit. So when we're looking at goods available for sale, what do we have? And you're going to do this a whole bunch in cost accounting. So goods available for sale is our beginning inventory, because we could have sold that, right? Plus purchases. because we could sell those. Gives me my goods available for sale. That's everything I could have sold. What I started with plus everything I purchased gives me my goods available for sale. So my beginning inventory is 6,500. My purchases are 6,300. So I have $12,800 that I could possibly sell. And that was using my beginning inventory and my net purchases. Does that make sense? That's everything I could have sold. So I'm going to go down here and I'm going to say, okay, my goods available for sale were 12,800. Now my cost of goods sold, that's what I did sell. So I'm going to go up here and I'm going to look for cost of goods sold. So I'm going to have to see, what did I sell? So if I had, so I can take my beginning inventory plus purchases minus what's still left, and that's going to give me what I sold. So here I took, this is what I started with. This is everything I purchased. So that's everything that I could have sold. Minus my ending inventory tells me what my cost of sales is. Or if I have goods available for sale, oh, I think I'm going to have to erase this. If I have goods available for sale, I can see that my cost of goods sold, I'm going to subtract my ending inventory. So I'm going to take my 12,800, which is everything that I could have conceivably sold. And if I subtract what I still have, which is my ending inventory, that's what I didn't sell. That means that I must have sold $10,500. Okay, we're looking a little fuzzy. Are we fuzzy? So now, if my goods available for sale are 12,800, that's everything I had available to sell, and my cost of goods sold, well, for gross profit, I need sales minus. Okay, so now gross profit is I have sales minus cost of goods sold gives me my gross profit, just like on your income statement. The top of your income statement models this. So my sales are 12,500. We figured out our cost of goods sold already. Down here was 10,500. Well, that doesn't take difficult math, does it? So my gross profit is 2,000. You can see there's some formulas here. So gross profit, 2,000. Net income from Krug Service Company and net income from Kleiner Merchandising Company. Oh, okay. So for that, you can do that. It's just revenue minus expenses. So for net income, obviously, we're going to take revenue minus expenses. Now, so this is Kleiner Company and this is Krug Company. Okay, this is what I wanted to show you before we got out of here. All right, so when we are figuring out the costs of inventory, there's four methods. There is specific identification, and this is used for something like a car lot or high-end jewelry, where like if you go and you buy that car, they're going to pull exactly that invoice that has to do with the car. They know exactly how much that particular car cost the dealership. And then there's first in, first out. We call that FIFO. First in, first out means, but all of these are cost flow assumptions. In other words, they're not physical inventory flow, they're only cost flow. So we're not using this for, we're not using this for figuring out how to pull the inventory or keep it. It's only for costing, because like, let's say you're selling office supplies, you have all these office supplies. Can you literally tell me how much you paid for that particular binder that I'm buying? No, you can't. So what we do is we use an assumption like this. The next one is last in, first out, which we call LIFO. And then the final one is weighted average. Okay, so we're going to work through each one of those. I just kind of wanted to give you an introduction for how they work, because the chart's a little weird. I'll tell you later. Okay, so we know that we use the perpetual inventory system. What the perpetual inventory system means is that it's more complicated because we're going to adjust everything after every sale or purchase. On your test, they'll say you're using the perpetual inventory method, but it won't really matter because they won't have sales in the middle. So that's why I say the test is easier. The problems on the test are very much like what I did on the Excel spreadsheet that's in one of the short videos. But you have to know how to do this too. So this one is specific identification. So we're going to go up here. So let's look at the table. So we have beginning inventory. We started with 235 units. We purchased 180, and then we purchased another 370. We don't have the cost of sales on here though. So here's what we're looking at. So when we look at, this is our data. If I was having you do this, if you were doing this on the test, I would say, first, remove sales and make a table without them. You just want your table with purchases, because that's what you're going to need on the test. But I'm going to show you all that. We're going to work through a ton of them on Thursday. So you don't have to know that right now. Here's what we have. We're going to use this data for all three parts of the problem. So we have beginning inventory, 235 units at $16. So I'm actually going to go down here and I'm going to go, we paid $16 for those. We had sales of 185 units at $25. The amount that we sold it for at retail doesn't matter, only the number of units. So in the beginning here, we had beginning inventory, 235 units that we paid $16 a unit for. On January 1st, we haven't sold any units. So in ending inventory, we have 235 units at $16 per unit. So our ending inventory right now would be $37.60. Now, everything here works in layers. So what we're going to do now is we're going to read specific identification. So ending inventory consists of 400 units. 370 are from the January 30th purchase. Okay, so I'm going to put in these purchases. So on the 20th, I purchased 180 units at $15. So on the 20th, I purchased 180 units at $15. And on the 30th, I purchased 370 units at $14.50. All right, now on the 20th, if we're looking at this, we have 400 units in ending inventory. I'm down here with the description. We have 400 units in ending inventory. Of those units, 370 are from the January 30th purchase. So I'm going to go down here and I'm going to say January 30th. So in ending inventory, I still have 370 of them. If I have 370 of those and I started with 370, I didn't sell any. And then 5 are from the January 20th purchase. So I'm going to go down to the January 20th purchase and I'm going to say, okay, I have 5 units left. If I started with 180 and I sold 5, if I started with 180 and I have 5 left, I sold 175 units. And then 25 are from the beginning inventory. So my ending inventory here is 25 units. If I started with 235 and I still have 25, that means that I have 205. 200? 205. I gotta see a neurologist. 210. I knew something was wrong. Okay, so this is specific identification. And what this tells me is that on my balance sheet, my ending inventory would be 5,840, and my cost of goods sold would be 5,985. Okay? Yes, sort of. You guys are tired. Okay, so now we're going to do weighted average perpetual. You know what? I want to do that one last. We're going to do FIFO. So FIFO, we have to think, okay, that's first in, first out. So I'm going to start with my data. On January 1st, I have 235 units at $16 per unit. So remember I said here, everything has to do with layers. Everything with this inventory has to do with layers. So this is my first layer. Layers can have more than one, but this is my first layer. That's where I'm at right now. So on January 10th, I made a sale. I sold 185 units. So I'm going to go down here and I'm going to say, okay, I sold 185 units. Now, first in, first out, but we only have one layer, so it doesn't matter. I had to have sold the ones that are $16 per unit because that's all I have. So that means if I started with 235 units and I sold 185, I
Yes,
now
50.
have what?
50.
Right, thank you. I now have 50 units at the $16 because that's my only layer. Okay. On the 20th, I made a purchase. On the 20th, I bought 180 units at $15. So I'm going to go down here and I bought 180 units at $15. Now I have 2 layers. My first layer is I have 235 units. At $16. And my second layer is I have 180 units at $15. So this is now my layer. I'm not worried about the one above it. Now this is my layer. Everything is going to go off of this layer. And the way we're going to do that is we're going to say, okay, so on January 25th, I sold 200 units at $25. All right, so I'm going to go down here, and this is where it gets fun. I sold 200 units. Now, the problem is I'm going to erase that box because I put it somewhere where it's hard to see.
I'm sorry. I have a question. If we had 235 on January 1st, we've reduced it to by 185, giving us a remaining inventory of 50.
Mhm.
Then we purchased another 180.
Oh, you're right.
That should be 230 left over. So 50 at $16,
Mhm.
180
All right.
at 15,
Mhm.
giving
Right.
us 230 total items, right?
Yep, you're right.
Okay, I just want to make sure because I was like, I
Nope,
don't.
you're right.
All right.
All right, so this is our layer. This is all we're looking at right now. We're not looking at anything above it.
Got it.
We sold 200 units. The way we do this now is, if this is first in, first out, the first units in were how much?
There's 50
50 at
left.
16.
50 and 16. So I need 200 units. So I'm going to take all 50. Now I still need 150 units. So I'm going to take the 150 units from the next layer. After I've done that, I have no more of the $16 layer. And I have 30 at the $15 layer. Now that we've done that, we only have one layer. This is our layer right now, but we're about to have more. So on January 30th, we purchased 370 units at $14.50. So I purchased 370 units at $14.50. So now my layers are, I have none at 16, I have 30 at 15, and I have 370 at 14. So this tells me a couple of different things. For each sale, I can see what the cost of goods sold and what the ending inventory would be. And then you just have to keep using different layers. You're not going to get this the first time. We're going to do the same thing this time, but we're going to use last in, first out. Last in, first out. So the data is the same. We started with 235, and then the first period we sold 185. So we sold 185. And they had to have been the $16 per unit because that's the only layer we have. Yeah. So we have 50 left at $16. Nothing's different from what we just did. On January 20th, we purchased 180 at $15. So I'm going to go down here. We purchased 180 at $15. So now we have two layers. We have our 50 at $16, and we have our 180 at $15. Those are our two layers, the 50 and the 180. Those are the only thing you're looking at now. On January 25th, we sold 200 units. Okay, so this time we're going to do last in, first out. So where do I start taking my units this time?
The 180.
The 180. So I need 200, so I'm going to take all of them. And then only 20 from the top layer, which leaves me 30 units on my top layer and none on my bottom layer. Then the last piece is we're going to look, we purchased 370 units at $14.50. So if we purchase 370 units at $14.50, now I have three layers. $30, I really have two because one's zero. I have 30 there, I have 0 here, and I have 370 here. I know it's a lot tonight. All right, I'm going to go back to the weighted average because it's easy, but there's something weird about it. Same thing, 235 units. The first two lines are going to be the same. We sold 185 units, so I'm going to sell 185 units, which leaves 50 left at $16. Okay, so there's my layer. On January 20th, we purchased 180 units at $15. So we've got 180 units, $15. So now I have two layers. I have my $50 and my $180. But there's something interesting about weighted average. So weighted average, instead of using last in, first out, or anything like that, we're going to say, all right, we have a total. Here's our layers. We have a total of $3,500. For that $3,500, we purchased 230 units total. So if we spent $3,500 on 230 units, then our price per unit must be $15.22. So that's what we're going to put here. We're going to say, okay, we're going to use 230 units at $15.22. That's the only layer that matters now. On the 25th, we purchased 200 units at $25. So now I have $530. We purchased. I have to do weighted average again. So now I have, let me go up top here. Now I have 3,500 to begin with, plus another 5,000. So I have 8,500. And for that, I bought 230 plus 4, so 430 units. So if I take 8,500 divided by 430, I have $19.77 per unit. So here I have a total of 430 units at an average of $19.77. Then on January 20th, I purchased 180 units at $15. So sorry, January 30th, I purchased 370 units at $14.50. So I'm going to say, okay, 370 units at $14.50. So now my layers are, I have a total of, need my pen again. I have a total of 56,008.
Now, Professor, the amount is 1977, not 119.77.
Thank you. This one? Oh, yeah, right. Oh, and that's a good example. I always say, look at the number and see if it could be reasonable. Okay, so I have 50, well, now that changed. I have 13,866.10 that I paid for a total of 800 units. So that's an average of 1733. So that's the amount that I'm going to use. And that's it. I mean, that's a lot. I don't mean that's it. Inventory is not hard if you think layers. You've got to think layers. The homework's just like this. It just has a few more layers. All right, you're also going to run into accounts receivable. Watch my video on it. I would say exactly what I'm going to say here. Watch my video on it. And then on Thursday, we will work every problem that's going to be on the quiz.
What would be an example of a company that even uses last in, first out? I can't really think of a product or service. Like
Produce.
that. Oh, okay.
But you also have to realize that it's not really physical flow. Yeah, I see what you mean, but also, like, let's say you had let's say you were in electronics and the prices were consistently rising. You might want last in, first out. But the problem is then you leave the older, cheaper inventory on your books.
Yeah, I don't know why like anybody
right.
would want that stuff.
Sitting on the books, the old stuff. Yeah. Right, because it reduces the asset value and it increases your cost of goods sold. Good thinking. That tells me you understand it. I'm so happy.
It's a lot of like dancing with the numbers and where they actually plug into the spreadsheets, and the concept makes sense.
Yeah, absolutely, positively, this unit, watch my short videos because they will really help you, because this is one of the areas, this and also accounts receivable, where students struggle. And also know when you're working this in the classroom, I would spend a couple of hours working these. I mean, first I do it, then we do it, and then you do it. And so it isn't something, it's not hard, but because there's so many things to think about, it isn't something that just comes automatically. After 30 years, I make it seem that way. It wasn't that way in the beginning. All right, call me if you have questions. Please watch the videos. And on Thursday, we'll review everything. Okay? Yes, good? All right, I'll see you on Thursday. Call me. Does everyone have my phone number? Because I see a couple of new people. I'm going to give it to you just in case anyway. Text is best because I'm getting all of these student loan calls that are like spam, and now they're spoofing other people's phone numbers. So if you text me, I'll respond faster because I'm trying to not answer my phone so they quit calling me. But it's hard when it's students, you know. Okay, I'll see you on Thursday. Have a good night. I'm going to stop sharing. Good night, you guys.